Imagine waking up one morning and feeling like money has quietly changed. Your savings are still there, your wallet looks the same, but something invisible feels missing. No gold, no silver, just paper and belief. On August 15, 1971, while families sat in warm living rooms watching television, President Richard Nixon appeared on screen and calmly delivered a message that would reshape the global economy. In a single sentence, he announced that the US dollar would no longer be backed by gold. Nothing visibly collapsed that night, but money lost its anchor, and the world stepped into an experiment built entirely on trust. To understand why this happened, we have to return to the ashes of World War II. Economies were shattered, currencies unstable, and global trade desperately needed a stable foundation. So in 1944, world leaders gathered at Bretton Woods and designed a new financial order. Every major currency would be tied to the US dollar, and the US dollar would be tied to gold. $35 meant 1 ounce of gold. It was simple, elegant, and reassuring. Gold became the lock, the dollar became the key, and for decades the system created stability and growth across nations rebuilding their futures. But beneath the surface, pressure was quietly building. By the 1960s, America began spending heavily on war, welfare programs, and ambitious projects like the space race. Dollars flooded the world as global trade expanded, yet gold reserves inside U.S. vaults barely changed. Imagine a bank promising that every note can be exchanged for gold while secretly holding far less metal than promised. At first, trust hides the imbalance, but eventually questions emerge. Countries like France and Germany began requesting gold in exchange for their dollars. Crates of gold quietly left American vaults, loaded onto ships crossing oceans, and with each shipment, confidence weakened. Inside government offices, officials watched gold reserves decline while paper money continued spreading globally. The balance between promise and reality began to crack. By 1971, the situation became unsustainable. America faced an impossible choice: stop printing money and risk economic contraction, or break the promise that held the system together. Nixon chose to suspend gold convertibility, calling it temporary. But temporary became permanent. In that moment, the world entered the era of fiat money, currency backed not by metal, but by belief in governments and institutions. The consequences reshaped modern finance. Exchange rates began floating instead of staying fixed. Inflation surged through the 1970s. Debt became easier to create and easier to expand. The global financial system transformed into a network driven by credit, central banks, and psychological trust. Today, every salary deposited, every savings account balance, every stock market rally exists within this fiat framework born in 1971. Money did not stop working that night. It evolved into something more abstract, more flexible, and perhaps more fragile. Before 1971, value was anchored to something tangible buried in vaults. After 1971, value became a shared story, sustained by collective belief. Trust replaced metal, and belief replaced scarcity. This shift allowed economies to grow faster and markets to expand further, but it also introduced new risks, from inflation to financial bubbles and mounting global debt. The unsettling truth is that modern money functions because society agrees it does. It is a system built on confidence, maintained by policy, and reinforced by everyday transactions that silently reaffirm trust. So the Nixon Shock was not just a policy decision, it was a philosophical transformation. It marked the moment when money stopped being a physical promise and became a psychological contract. Every financial decision we make today operates inside that invisible agreement. And that leads to a question that lingers quietly beneath the surface of modern finance. If money is now backed only by trust, what happens the day that trust begins to fade?